This week, two of Australia's biggest banks, the National Australia Bank and ANZ, produced half-year profit. Both were strong, but warnings about future conditions caused NAB's share price to plunge on the day it was released. Tomorrow, it's Westpac's turn, and this week there will be a quarterly number from the Commonwealth Bank as well. But as interest rates rise and borrowers are squeezed, the way that banks manage stressed customers will become an important benchmark for bank executives. Shayne Elliott is ANZ's chief executive, and I spoke with him a little earlier.
Oh, there's definitely stress across the economy. You know, to some extent, we're dealing with an inflation problem across Australia and the world for that matter. And of course, central banks are fighting hard by raising interest rates. That causes pain. And that causes pain for some more than others. And you're starting to see that come through. The good news is that actually, when we look at our customer base, our million homeowners or our 600,000 small businesses, actually, the stress is kind of hard to see in any material way, and it's much lower than it was at any time pre-COVID. So we're sort of going into this period in pretty good shape. So there's a few points of stress, but not many, to be perfectly honest. OK, so you can see that even in the results, which are clearly very strong. The return on capital is very strong for the shareholders. Your Tier 1 capital is rising. That's strong. That's a sign of a strong bank. What I'm wondering about is what happens to Australia's economy and to banks when unemployment rises from 3.5% as it is currently out to 4.25% towards 4.5%, as is forecast by the Reserve Bank and Treasury. Yeah, so great question. And it's sort of our base case when we think about the provision. So you talked about capital. So in addition to that capital, we have a whole bunch of provisions, sort of like capital, set aside just in case. And the way we determine the right amount to set aside, and at the moment we've got about $4 billion set aside. Part of what we do is we run a base case for the outlook. And our base case happens to be that unemployment in Australia might get, and again, these are downside scenarios, might get to 4.4%. And a whole bunch of other things. So when they said, hey, if that happened, based on our models, how many losses would we have and how much capital would we need for that? And that's why the models basically say, oh, you'll need about $2 billion. And then we through a whole bunch of other things, we adjust it and we come up with $4 billion. So I think the banks are really well positioned. That's still pretty modest. And I think the banks are in really strong shape, certainly ANZ, if that is to be the outcome.
So what you're telling me is if the unemployment rate goes to 4.4% as you model, you sense that with all the provisions and everything that might come, it will cost the bank $4 billion in future earnings. Now, that's the interesting side about this.
No.
Go on.
No,
in future provisions.
Maybe I misspoke a little bit.
Right.
Yeah, no, let me misspoke. So we've already put the provision. It wouldn't be $4 billion. What we're saying is, so as I said, the model says we'd need $2 billion. We've put aside $4 billion.
Right.
If that happened, and it would depend on all sorts of other things, we've already got that money. So we would still be able to operate. We still have the same amount of capital, still be able to go out and lend, still pay dividend, generate profits. We'd use those reserves in that event. So by and large, our shareholders and customers that wouldn't really notice.
OK, so then the NAB this week, with its statement when it came out, there was a lot said about the number of homeowners who are locked into their loans and cannot negotiate. Now, I did notice the number of home loan customers that you've got with LVRs above 80% is rising right now. Now, it's noticeably rising. Do you have the similar situation where some of your customers simply could not get up and change banks if they wanted to, effectively being locked in?
So I saw that, and look, I've only seen what I've read in the papers. I have to say I was a little bit surprised by that. That's certainly not the experience that we have at ANZ. I think it's important to give people some context. Your average Australian person with a home loan, certainly if you're an ANZ customer, the average home loan we book is about $300,000, right? Most people, when they enter into their home loan, they don't borrow to the maximum of their capacity. They borrow less than they might otherwise be entitled to. So the numbers, when we run it through and say, hey, who are the people who may not be able to get in, if they wanted to refinance tomorrow, would struggle to get approved, either because they can't service it or they don't have enough equity in their homes. At ANZ, that number is a very, very low single-digit percentage of our 1 million customers. So I was a little bit surprised to read that. That's not the experience we have at ANZ.
OK, then take me to another thing. I did notice in the statements that you noted that liquidity is pretty strong at the moment for the bank. And with your credit ratings and everything, you can go to the international markets, get the liquidity, get the funding you require to do your lending and everything else like that. But with what's taking place in America at the moment, First Republic, a number of other banks have collapsed. regional banks in some strife over there. Do you worry about the prospect of that liquidity drying up, a credit squeeze happening around the world?
Well, of course, we worry about that all the time, and there are times where there's more heightened worry. I mean, liquidity is our lifeblood, right? The good news is that Australian banks are some of the best regulated in the world. Our liquidity requirements are much stronger than any of than in the United States, and certainly with the regionals there, and the sorts of things, the stress testing and the amount of liquid assets we have to hold. It's a completely different ball game here. That doesn't mean that we are complacent. I think actually what's been really interesting, Ross, given our credit rating, given the respect globally for the Australian banking system, and I include the regulators in that, ANZ was actually one of the first banks globally after Silicon Valley Bank came and failed to get out into the international markets and actually raise debt. And what we found is there was lots of support. So we're still a very attractive place to lend to. And even more, I think more interesting, more recently with the failure of First Republic Bank and others, what we've seen at ANZ, and remember we're an international bank, we've actually have seen a bit of a flight to quality. So we have seen some deposits from very, very high rated customers who are actually coming to us because we're well regarded, we've got the right, it's not just about price and the balance sheet, we've got great capability in our cash management and transaction processing businesses, and that's actually being a bit of a magnet for business.
Just one other aspect about that, because you talk about the flight. The interesting thing is these days, with electronic transfers and so forth, the movement of this money becomes much more rapid, doesn't it? If people are chasing the low Aussie dollar, your higher interest rates, because I do notice you've actually raised the amount of deposits you've got by $9 billion over the past year, which is going some in a 12-month period.
Absolutely. I mean, I think one of the things that regulators are struggling with, and you'll remember this actually, Ross, back in the GFC, you might remember Northern Rock in the UK, right? And when that failed, and there was a classic run on the bank. And at that time, and that's really what kills banks, right? When depositors flee. In those days, and further behind it was the sort of physical run. And now, of course, the run on the bank means you get out your mobile phone and you click a few buttons and you can move money at will. And that really came through in First Republic Bank in particular, where you saw them, they had $176 billion in deposits and $100 billion of it fled in one quarter. I mean, that's quite remarkable change, right? So yes, technology and the ability to ease at which people can move money is a great thing for consumers. I mean, it's wonderful to have that convenience, but it presents a different challenge from a regulatory point of view and as a prudent, well-managed bank for us to give regard to. And one of the strengths of ANZ is the diversity of our funding. And so we don't have any one particular area that we raise funding from. No, in Silicon Valley Bank's case, it was really from just the tech industry. So we've got a retail bank, we've got New Zealand, we've got institutional. In fact, one of our biggest providers of liquidity at ANZ is small businesses. So we service a lot of small businesses. They leave money with us. So it's great to have diversity in your funding, and that's a real strength. And then, of course, just, as I said, in terms of regulation and the sort of liquid assets that we have to hold in case those movements happen, we're in a really, really strong position.
So, Shayne Elliott, I know that you have got a landmark birthday this year, so can I just take it and presume that you're going to be here for the next results? Is that likely or not?
Well, certainly my plans, absolutely, yes. I'll be turning 60 later in the year, and I'll be looking forward. And one other thing I will say, this is a landmark result. This is the first time we had a result as in our new non-operating holding company structure, which I'm really thankful to shareholders for supporting it. So that's going to provide great flexibility for the future. So I have a bit of a milestone that can never be taken away from me, Ross. I am the first CEO of that non-operating holding.
Shayne Elliott, always good to talk to you. Many thanks for your time today.